Hello everyone, this is part 2 of financial ratio analysis. In this video we're going to continue on talking about financial ratio analysis, and we're going to start with using financial ratios in financial models. So financial ratios are often used in forecasts to predict line item values based on the relationships between line items over time. So for example, if the gross profit margin that we talked about in the previous video for our firm has consistently been 60% for the past several years, the current year's revenues are $90,000 and the expected growth rate in revenues for the next year are 10%. What is the expected gross profit for the next year? So we can calculate this based on the information that we have here. We have the previous year's revenues and we have an expected growth rate of 10%. And so we would expect next year's revenues to be equal to the previous year's revenues, $90,000, multiplied by 1.1, so 1 plus the growth rate of 10%, and that would give us a value of $99,000 for our revenues. But what we want to know is our gross profit for the next year. So we know that in the past, over the past several years, the gross profit margin, which is gross profit divided by the revenues for the year, was equal to 0.6 or 60%. So to find this year's gross profit, so next year's gross profit, we're going to take 60% of the expected revenues for next year, or 99,000, multiplied by 0.60, which is again our 60% gross profit margin, and that's going to give us a value of 0.6 multiplied by 99,000, or 59,400. So moving on from that, we're going to start now talking about market value measures. These differ from the other ratios that we've looked at so far because all of the other ratios can be calculated from the income statement, the statement of cash flows, and the balance sheet. This new set of ratios, though, incorporates market values of specifically the stock of the company. And so we have to go beyond what's just provided in the financial statements and start looking at the prices of the stocks for the firm. So what I have here is, it says, well, profitability ratios show the effect of managerial decisions on the accounting returns of the firm, like net profit margin, return on assets, return on equity. Market value ratios demonstrate the effects of managerial decisions and external events on the investor's perception of the future of the company. And that's really key here because those stock prices incorporate future expectations that investors have about where the company is going. All of the market value multiples indicate the perceptions of investors regarding the future value of the company compared to those of its peers. What do higher market value multiples imply about investors' perceptions about the future of a firm? So higher market value multiples imply that the investors' perceptions about the future of the company are good. Whenever we see these multiples increase, this means that the perception relative to other firms, this means that investors have a higher expectation about the future of the company. So higher market value multiples imply that investors' perceptions are positive. Okay. Total enterprise multiples are useful when comparing firms that have very different capital structures. So what the total enterprise value of a firm is its market capitalization plus its net debt plus the minority interest. that the firm has. So market capitalization is equal to the product of the number of shares outstanding multiplied by the current price per share. Okay. Net debt is defined as short-term debt plus long-term debt minus cash and cash equivalents. So the key term here is net. The idea behind net debt in the calculation here is that any cash the firm has could be used to pay off any debt that it has. So we want to take into account the idea of net debt, or this idea of cash as being negative debt, the ability to reduce that debt immediately if necessary. Minority interest is kind of complicated. The idea is that you can have business enterprises that are owned by more than one entity. So think of a joint venture between different firms. One company might own a certain percentage and another company is going to own another percentage of that joint venture. So a minority interest represents the ownership of a subsidiary of less than 50% and shows up on the balance sheet of the company that owns a majority interest in the company, in the subsidiary. It's included in the total enterprise value multiples, and I have two examples here we're going to go into, because the denominators contain information about the entire enterprise and not just the portion owned by the subject company. So whenever you see EBIT or EBITDA on a financial statement, that also includes the EBIT and EBITDA of a minority interest company, or subsidiary, I should say, that the company owns a majority of. So let's say company XYZ owns 60% of company ABC. Okay. Because they're a majority owner, the entire amount of EBIT and the entire amount of EBITDA for that company, for that subsidiary, is going to show up on their financial statements. You're also going to then see a liability typically for the portion that is not owned by them, owned by the company. So we have here the total enterprise value divided by EBIT and the total enterprise value divided by EBITDA. The first one here, we've talked about this before. EBIT is the operating profit of the company. So this is the total enterprise value divided by operating profit, earnings before interest and taxes, and this is the total enterprise value divided by the operating cash flow of the company. Or earnings before I have an extra comma in there. Earnings before interest, taxes, depreciation, and amortization. And again, the reasons why we would look at these numbers are twofold. First of all, these are nice to compare between firms, especially if those firms have very different capital structures, because it takes in the total value of the firm, the total enterprise value, which is going to be the debt plus the equity of the firm. We divide it by something like EBIT or EBITDA because it is a way to compare the overall value of the company based on a unit of value that the company produces. So let's go out and look at McDonald's again here. So I'm going to go out here and I'm showing you this first page here. This is Capital IQ again, and we're looking at the multiples measures here. And so I'll just show you this first one here, and we're looking at trend analysis over time. This is the total enterprise value divided by the last 12 months EBITDA, or operating cash flows. And so we can see here what's been going on, and there's not really anything, no distinct trend happening here, but the average total enterprise value divided by the last 12 months operating cash flows has been 17.23 times, and this was in March 31st of 2023. 18.65 times, 17.68 times. You can see these are every 3 months. So these are based on quarterly numbers. 16.36 times, and then 17.27 times. Down below, and so this is NTM, so next 12 months. So these are based on the estimated EBITDA for the next 12 months for the firm. So they look a little bit different. And then down below we have the total enterprise value last 12 months divided by the last 12 months EBIT. And you also see here, not a distinct trend. It increases and then it decreases, then it increases again, but it's been pretty stable. We can go out here also and compare these, and this is really where these values, these calculations have a little bit more value. I'm going out of here to Quick Comps. And we can see here, I'm going to go to trading multiples. So we have total enterprise value divided by EBITDA. One of the numbers we were looking at last 12 months. We can see down here for McDonald's it was 17.3 times. Now this is where these multiples become a little bit more valuable because we're comparing them across different firms at the same time. So this is your benchmark analysis. We can see here that McDonald's is kind of in the middle. We can see of all these competitors up here. The median is 16.3. They're at 17.3, so slightly above the median value. Certainly there are some companies that have higher values here than McDonald's. Certainly Chipotle looks a little bit better in terms of this number, 27.2. Wendy's is a little bit lower. So what this means is that based on that unit of measure, the EBITDA, investors have a higher expectation for Chipotle for every dollar of operating cash flows that the companies are generating right now, and investors have a little bit lower expectation for Wendy's based on this value of measure. And this is, we see this is actually consistent with the EBIT over here as well. 42 times for Chipotle versus 22.5 times for McDonald's. For Wendy's, however, is 19.5 times, so a little bit lower expectation there. So this means that investors overall are paying more per dollar of cash flow or operating profit generated for Chipotle right now than they are for McDonald's. If you think of value investing, so people like Warren Buffett who try to find good value investments, they're actually generally looking for lower values on these multiples because they think, if Walmart isn't, or excuse me, not Walmart, McDonald's isn't as expensive right now as a company like Chipotle, maybe McDonald's is a good buy. And so that's something to keep in mind whenever you analyze companies and compare these companies. Moving on, price to earnings ratio is probably the most common one that we see. It's been around for a long time. It's been around for a long time because the information has been there for a long time. So all we need to calculate the price to earnings ratio is the current stock price, divided by the earnings per share. The earnings per share for a publicly traded firm, is reported every quarter, and so we get to update these numbers pretty frequently. Also, the price to earnings ratio only requires that we know the stock price and we know what was on the income statement in the most recent quarter. Prior to 1987, The only financial statements that firms had to, publicly traded firms had to provide, were the income statement and statement of cash flows. And so this is a number that has been around and been used for many decades. But it tells us, again, how much our stockholders, now because we're only looking at the stock price now, not the total enterprise value, willing to pay per dollar of earnings per share. So we have forward versus trailing EPS. The forward EPS is the expected EPS in the next coming annual period. And there's actually many ways to define that annual period. I'm not going to go into that much detail in this set of notes, but what I want you to know is that the forward EPS is the expected earnings per share for the next annual period. The trailing EPS is the earnings per share for the last annual period, or the current annual period, depending on how you're going to define that number. But what I want you to know is that the trailing EPS has already occurred, and the forward EPS is what is expected to occur. You might say, well, why would you ever use the forward EPS? Because that's always going to be a guess or an estimate. And the cases where you would want to use the forward EPS is if the recent history for the firm or for the market has not been representative of the norm for that company. So we can think back not too long ago. The calendar year 2020 was hard for a lot of firms because people stopped going out, they stopped shopping a lot, they stopped traveling, they stopped eating out, and really doesn't represent the norm for a firm, for many firms out there. And so, especially for larger firms that are better covered by analysts, that forward EPS is a very good number to use because it represents what people expect to occur in the future, rather than what happened during a specific year that isn't representative of the firm. So it should be used with companies that have, a lot of analysts. They're large companies with a lot of analysts and a lot of people invested in the company and interested in and watching that company because they're going to get better estimates for the future. For smaller companies, that forward EPS may not be as reliable, and so we want to make sure to maybe rely more on that trailing EPS for those companies. So why do stockholders care about earnings? Earnings are a good predictor of future value growth for a firm. When is the PE ratio not very useful? The PE ratio is not very useful when that earnings number is either very small or negative. Oh, sorry, I have PE. The earnings number either very small or negative. In these instances, the PE ratio has little economic meaning. In fact, if the earnings value is negative, Capital IQ, the site I've been showing you, will actually show an error term for the PE ratio rather than report a PE ratio, because it doesn't make a lot of sense when it has a negative number. So let me go out here to again look at McDonald's PE ratio, and like I mentioned before, comparing this ratio across firms is usually the way we want to take a look at this. Looking at it over time can be useful to kind of see if there's any trends with how the perception of the company is going. But typically what we look at primarily is comparing it across firms. So again, this bottom line here is McDonald's. It's at 26.2, and this is the price to diluted earnings per share before extraordinary items for the last 12 months, which sounds really kind of complicated, but really it's the price to earnings ratio for the last 12 months, based on the earnings per share for the last 12 months. So we can see here, common thread, Chipotle, this top line here, is much higher than McDonald's. People have higher expectations for that firm based on its earnings per share. I mentioned there being an error term. So in this case, if we look at the bottom one here, Shake Shack, the price to earnings ratio, they're not showing what that value is, and it's likely because the Shake Shack had a negative earnings for that period of time. And just so one other one, Wendy's, we mentioned Wendy's before. They have a lower expectation based on the earnings per share, the price to earnings ratio for the firm. And again, that's consistent with what we've seen with the other multiples. So the next multiple is one that I really like. You're going to see this if you're in finance for very long. You're going to see this ratio quite often. It's the market to book ratio. One way to calculate it is we take the price per share of the stock divided by the book value of equity per share for the stock. You're also going to see this one, and I'm going to show it to you here in a minute, out on Capital IQ. You'll see P divided by BV, which is the price to book value. It's the same ratio, but you'll see market to book ratio out there as well, and that's a fairly common one to see. The book value per share is the total stockholders' equity divided by the number of shares outstanding, and which I mentioned down here. It's also commonly referred to as the price to book ratio. So why do I like this ratio so much? I like it because it is a fairly common measure of the value added by management, by how they use the assets that they have. So what I have down here in this box, the market to book ratio is an applied configuration of Tobin's Q. Tobin is a famous economist. He came up with the Q measure of the economic value of a firm's capital. So one possible presentation of Tobin's Q looks like this. Q ratio is equal to the total market value of the firm divided by the replacement cost of its assets. Now, we don't see this oftentimes in when analyzing companies, because this can be hard to calculate. The total market value of the firm is going to be the market value of the company's stock plus the market value of the company's debt. So we would take the market value of its bonds and any loans outstanding, and then divide that by the replacement cost of assets. The replacement cost of assets can be difficult to calculate because instead of looking at the balance sheet, which is the historic cost usually of the assets, we'd have to go out and get an appraisal or an estimate of what those assets would sell for today if we had to replace them. If we had to go out and replace all the buildings and the equipment and everything for the firm, we'd have to get an estimate of that. So it's hard to calculate it, but the idea is this. The Q ratio represents the additional value that management has added to those assets by how those assets are employed. Okay. So what I have down here, if the market value of the firm is greater than the replacement cost of its assets, then management has added value to the firm. To add value, management must give investors more than their required rate of return, which usually requires barriers to entry. In other words, if I can take, and I use this example sometimes, a chair, okay, and I can go to, we'll go back in time and pretend that people still go to malls and, they like to shop around the holiday season, and I can take a chair that costs, say, $100, and I can set my chair out, and the weary spouse or significant other that's going along with the shopping trip but really doesn't want to be there, their feet hurt, they just want to sit down, I can charge them $5 an hour to sit in my chair. So I have my chair, they're at the mall, they're sitting down, they're going to pay me $5 an hour to sit in that chair. Okay. Now, let's say I decide this is my business and I'm going to sell stock in my business. I have one asset, it's worth $100. If I can then go out and sell stock and get investors to say, hey, this is a great investment, give me your money and I will give you the profits from my company in exchange for that money today. And I go out and I raise funds and I raise $200. Okay, the market value of my company, the stock, is $200. The replacement cost of the asset, the singular asset, is $100, that share. My Q ratio would then be equal to 2. And my Q ratio is equal to 2. I'm doing a great job as a manager. I've added value to that share by how I've employed it. I've taken it, I put it in a place where people want to sit down, and I'm charging them to sit down. The problem with this is that someone's going to come along and they're going to say that I'm charging $5 an hour to sit in my chair. Okay. They're going to put down a chair as long as nobody stops them. And they're going to charge $4 an hour. Okay. And what's eventually going to happen in this scenario is that people will come along with their own chairs as long as there's no barrier to stop them from doing this, and they're going to charge a lower and lower price until the market value goes down to $100. The market value of that company goes down to $100 because at that point the replacement cost of the asset, that share, is equal to the market value of that share. So what we look for when we think about adding value to a firm are barriers to entry. Think about if you have an iPhone. Okay, most current version of the iPhone, the average price is about $1,000. It costs much, much less than that to produce that iPhone. How can Apple charge so much more than the cost of making the iPhone? It's because of barriers to entry, because of patents and copyrights and the trademark of Apple, which is so valuable, that's attached to that phone. And so what we look for when we talk about adding value is our barriers to entry, ways that we can produce something of value that people want, and also that other people cannot come in and easily compete against. So some common barriers to entry are patents, trademarks, copyrights, and access to natural or limited resources. Okay. There are other ones out there. High startup cost can also be a barrier to entry, and things like that. But these are some big ones that do easily add a lot of value to a company if they're able to get those in place. So if a company operates in a perfectly, I have that in there twice, in a perfectly competitive industry, what should its Q ratio be? Its Q ratio should be equal to 1. its Q ratio should be equal to 1, because through competition, the value of the firm, or the value of the assets of the firm, the market value, will decrease through price competition or other types of competition, to reduce the value added just to the required rate of return for that company. So let's go out here and let's take a look at the market to book ratios for McDonald's. So the price to tangible book value, that's what we're going to look at here. So you see all these NMs, and this is an interesting problem because this is due to stock repurchases. Companies, I'll just show you here. We'll go out here to McDonald's balance sheet. So remember, the denominator here is the value of common equity. Well, we see here for McDonald's that the value of common equity is actually negative because they've repurchased so many shares of stock. Okay. So I'm going to go out to Walmart instead. Because we know for Walmart this isn't the case. So we can see their total equity is positive. Their book value of equity is positive. They do, I mentioned minority interest before, they do have a minority interest. You can see that out here. And I'm going to now go out and look at the quick comps, the comparable firms for Walmart, so we can see the price to book value here. So when we look at the price to book value, again, this is tangible book value for the last 12 months. The price to book value for Walmart is 8.3. We compare it to other firms. Walmart's actually doing pretty well. The median for the comparable firms here is 6.6. Costco has a higher price to book value ratio of 11. Dollar General has a much higher, and BJ's Wholesale Club has much higher price to book value ratios than Walmart does. However, many companies have a lower value. Here we see Dollar Tree, Kroger, Target, all have lower price to book value ratios. And so again, this is a way to see how investors perceive the company compared to other firms. Just one last little note here about the market to book value ratios. If you get into investing, you might hear value versus growth. So a value company is a company that has a low market to book ratio. Or price to book ratios. Growth firms are firms that have high market to book value ratios. Over the past 10 decades, value firms have traditionally outperformed in the long run growth firms in terms of stock returns. This wasn't true for the decade ending in 2020, and that's only because of the year 2020, really, in which growth firms outperformed value firms by a large margin there. But in most cases, over time, value firms have outperformed growth firms. So looking for those cheaper companies, those value investments, the ones that aren't as flashy or as exciting as as a lot of the big new companies out there can pay off in the long run. Now we're going to talk a little bit. We're done now with the ratios. We're going to take a look at the idea of market efficiency. And what is market efficiency? Market efficiency is the idea that stock prices accurately and quickly react to new information. Market efficiency is important, and we're going to get into this here in a minute. Market efficiency is also the idea that prices are accurate. So they accurately and quickly respond to new information, and the prices are accurate. They represent reality for whatever's being priced. And usually with investments we're talking about firms, but we can also talk about individual assets too. The price of a house, does that price that you see in the marketplace accurately reflect the value of that house? Does the price of a car that you see on a car lot accurately reflect the value of that car? Why is market efficiency important for a functioning market? If people don't trust prices, then people will slow down their decisions. They won't trust their decisions on buying and selling assets, and so that slows down the process. It creates frictions within the market. So I want you to think about when you go to buy a car. Okay, so if you were to go to a car lot and just pay the price that they have listed on the windshield for a car, a lot of people would tell you that's not a good idea. And they would be pretty safe in saying that, because the idea is that you go and you haggle for the price. You go and you talk about the price. You try to figure out, how can you get that price lower? Is this an accurate price of the car? In general, people don't just go and pay the sticker price for a car unless the car is in really high demand or we're in kind of a situation where there's not a lot of cars out there. So the reason why market efficiency, being able to trust in prices, is important for a functioning market is that inefficiency, or a situation where prices aren't reflecting reality or the true value, slows down or creates frictions within the market. Market efficiency decreases trading frictions. Okay. And it allows markets to flow and funds to flow more easily within that marketplace. We have three different ideas or three hypotheses out there about market efficiency. The first hypothesis is referred to as the weak form hypothesis. The weak form hypothesis says that prices reflect all historic pricing information. Prices reflect all historic pricing information. The semi-strong form hypothesis says that prices reflect all publicly available information. And then the final hypothesis, the strong form hypothesis, says that prices reflect all public and private information. So I'm just going to go out and pull up a stock price for you. So we've got Walmart here. So I'm just going to go out to their tear sheet and take a look at what the current price as of the day I'm looking at this, which is January 3rd. So right now, the stock price for Walmart is $159.66 per share. So that represents what an investor is currently paying for a share of Walmart stock. This share of stock will get them a certain amount of dividends every quarter. And what we see here is that the dividend yield is 1.4%. So on an annual basis, they're getting 1.4% of this stock price in terms of a cash payment. The earnings per share is currently $6 per share. And so again, they're paying $159.66 for $6 of earnings per each share that they have. And so the idea behind market efficiency is that this company, the ownership percentage, the dividends you're going to receive, the earnings that are generated by your ownership percentage is worth $159.66 right now. If investors believe that it's much higher than that, it's actually worth, let's say, $250, then investors would go out in an efficient market and buy that stock up until that price hit $250. Okay? And then the trading would probably not stop, but trading volume is going to go down quite a bit. If people believe that the stock price is only worth $50, they're going to do the opposite. If I own this stock right now at $159.66, but looked at the company and said, you know what, I think the company's only worth $50 per share, I'm going to sell my shares right now while it's still worth $159.66. And all the other investors that believe the same as I do would do the same thing until the stock price goes down to that $50 per share. Okay. So that's how market efficiency works. Is that if the market is efficient, then prices that we see accurately reflect the reality, the value of the assets or the companies that we're looking at. And when information changes about those companies, or those assets, then the stock prices and the prices of those assets change to reflect that change in value. So we have these three hypotheses, and in general, academics tend to favor the semi-strong form hypothesis. We know that the market is not strong form efficient, okay? Because you can earn excess returns if you have insider information and you're trading on it, which is illegal, so please don't do that. You can earn additional returns by trading on insider information. Again, it's illegal. Please don't do it. So we know that's not true. There's been many tests of market efficiency. And again, in general, we know when new information comes out about a company, then prices move and react to that information. Weak form hypothesis indicates that trading on technical information, in other words, trading on movements in stock prices, should generally not produce returns that exceed what you can get on average, or essentially not consistently produce above average returns. And that's because that information is already priced, or should, based on that hypothesis, is already priced into that stock price or that asset price. So that's just a little bit on market efficiency. Now I'm going to talk a little bit about industry and the macroeconomic environment. So the ability of a firm to generate income and cash flows is grounded in the industry or industry that the firm competes in. Michael Porter is a famous person in management. He came up with Porter's 5 forces of industry structure. And these are things that we look at when we're doing a top-down approach or top-down analysis of a company or of investments, that we look at to see if an industry is one that we want to invest in. So you might think of it this way. When you go to buy a house, one of the most important things you can look at is the neighborhood the house is in. Okay? A great house in a bad neighborhood is not generally a house you want to buy. A bad house in a good neighborhood, you can fix up the house, but it's hard to fix a neighborhood. And so that's what we do when we look at investments. We look at the neighborhood. We look at the industry that the company's in. So the first force that Porter talked about was intra-industry rivalry. In other words, is there a lot of rivalry within the industry? And you can think back to the cola wars back in the 1980s, if you want, with Pepsi versus Coke and how competitive they were. Nowadays, we see car companies compete at a high level. Firms that have high levels of intra-industry rivalry tend to have lower profitability. Okay? So higher levels of intra-industry rivalry lower profitability. Because either they're going to be competing on price or they're going to be competing on research and development and advertising and pushing up their cost in order to beat the other firm in the industry. Where we have low levels of intra-industry rivalry, we generally have higher profitability companies. Barriers to entry. I mentioned this before with the market-to-book ratio. Firms with higher barriers to entry or industries with higher barriers to entry generally have higher profitability firms within them. So high barriers to entry result in higher levels of profitability. The existence of substitute goods. So a higher level of substitute goods results in lower levels of profitability. So what is a substitute good? A substitute good is usually a good that is lower cost than the one that the industry makes and can be substituted for whatever the industry makes. So the example of a substitute good for an industry might be coffee versus tea. If the price of coffee gets too high, then consumers who want the caffeine and want something warm to drink might choose tea instead. So the existence of tea as a good substitute for coffee limits the profitability of companies that make coffee. Just as an example, the fourth is supplier power. So supplier power is the idea that a supplier of goods or materials to an industry can control that industry because that industry needs whatever product or whatever raw material that's being provided by the supplier. So supplier power occurs when a supplier to an industry is responsible for a large portion of sales in that industry. A good rule of thumb is that no supplier should be responsible for more than 20% of sales within an industry. The higher the supplier power, the lower the profitability for the industry. Because that supplier is going to want to take as much profit as they can. And so they're going to limit the profitability of the firms within that industry by taking as much profit as they can. Buyer power is the same idea. Another word for buyer would be the customer. So buyer power occurs when a customer of an industry is responsible for a large portion of sales in that industry. Again, a rule of thumb here: no supplier should be responsible for more than 20% of sales within an industry. The higher the buyer power, the lower the profitability of the industry. To give you an example of this, we were looking at Walmart. Walmart used to have a policy that they didn't want to make up more than 10% of the sales of a company. So I want you to think about the things that you buy. If you shop at Walmart, the things that you buy at Walmart, it might include a lot of things like shampoo and deodorant, toilet paper, and all those things, personal hygiene items. So one important thing to understand about a lot of businesses out there is that you might think of a company like Procter & Gamble, okay? The end user is not really the customer of Procter & Gamble. Procter & Gamble, companies like that, don't sell directly to the consumer, okay? In general. They sell to retailers. They sell to Walmart. They sell to Target. They sell to Dollar General. And in some categories, some product categories out there right now, and this is a problem that Walmart ran into with their policy of not being more than 10% of a customer's sales, is that Walmart sells more than 10% of the items the being manufactured within the United States, that are being sold within the United States of a company. Okay, so they had to abandon this policy, and the reason for that policy is that they didn't want to be the reason that a company went bankrupt. Okay, they didn't want to be the reason that if they decide not to carry a certain product anymore, that the company would go under. And I guess unfortunately they've not been able to maintain that because they have gotten so large within certain product categories. So it's one thing to look out for, and one thing to understand is that if you're looking at a company, be aware of who the true customer of that company is. It's the organization that's buying the product. So in this case, Procter & Gamble's customer is not you, it's Walmart or it's Target. And that can cause problems for that company. I know a lot of companies ran into this problem with Amazon, for example. When Amazon decided to start competing against them directly, in a lot of cases, Amazon will have their own Amazon brand now. And as the buyer of those brands directly competing against them really hurt a lot of companies in that way. So it's something to keep in mind as you analyze it and look at companies. We're going to move on now from the 5 forces to the Porter, same guide, Michael Porter, 3 generic corporate strategies. And there's 3 generic corporate strategies that he said that firms can take within an industry to maintain or increase the firm's competitiveness. The first is cost leadership. In other words, the goal here is to offer the product at the lowest cost. And that's how the firm would compete within an industry, is to be the low-cost leader. Differentiation, the strategy here is not to offer the lowest cost. So the strategy here is to offer a better product that can be differentiated between products. So a good example of the difference between cost leadership and differentiation is when you go to buy milk. Okay, so if you're like most people, if I were to ask you, you go to the store to buy 1% milk, let's say, how are you going to make your decision? There's more than one option up there. How are you going to make your decision? A lot of people, if they don't care, about anything special about the milk, they just want 1% milk. They're going to go with the cheapest one. Okay, they're going to go with the least expensive brand that's on the shelf, and that's going to be cost leadership. Okay, that's an example of cost leadership, getting customers to buy your product because it is the lowest cost item. Nothing special about it. It's 1% white milk. That's it. However, other people are going to be interested in things maybe they don't want cow milk, they want almond milk, or they want soy milk. Well, that's differentiation. Okay, the company has put a different product out there. Or maybe they want to say, okay, our milk comes from cows that are hormone free. No antibiotics were used on these cows, no hormones were used on these cows, and so our milk represents something different than the other milk. Maybe our milk is a little fresher than the other milk. Those are ways to differentiate. And so those companies would follow a differentiation strategy. And then we have focus. And focus can be a little bit confusing here, but we have cost focus and we have differentiation focus. The idea behind the focus strategy is that the company is not aiming for the entire market. They want a specific, well-defined subsection of the marketplace that they're aiming at for their customers. Okay. So there is both a cost leadership focus and also a differentiation focus. When we talk about focus. And down below I've got a little graphic here that shows kind of how this works. So the focus strategy, we have a narrow target market. We're not trying to get every customer out there. We're trying to get specific groups of customers. Broad target market is going to be cost leadership for everyone. We're trying to just provide the lowest product that people commonly want at the lowest price. Okay, and then with differentiation, we're trying to get customers that want something different, but we're not aiming at a certain subset of the market. I've got an example here of Nike. So Nike, what industry does Nike operate in? Generally seen as sporting shoes and sporting apparel. So which companies are Nike's main competitors? And I've used this example many times in my classes, and so I can kind of give you the answers that I typically get when I ask this question. So we generally see Reebok as a competitor, Under Armour is a fairly consistent competitor, Adidas. In general, they're in that apparel, shoes category. Intra-industry rivalry. So intra-industry rivalry is actually pretty high. it's pretty easy to say who they're competing with, and they're pretty aggressive competitors. They're through their advertising and their promotion, they tend to be fairly aggressive. What are the barriers to entry? So the barriers to entry are probably medium here, maybe a little bit high. It's hard to get established as a new athletic company these days, athletic apparel company these days. So I'd say medium to high here. Are there substitutes? Yes, there's many substitute goods for Reebok, Under Armour, Adidas, Nike. Go to Walmart, go to Kmart. You can find shoes that are off-brand or fairly generic athletic shoes and athletic apparel. So this is also fairly high. The substitutes would be fairly high. Supplier power. This is where they're probably in a good spot. They are not reliant on any one industry or any one supplier, for the things that go into making their apparels and their shoes. So supplier power would be fairly low. Finally, buyer power. And this is again where we want to think about who the customers of Nike are. So Nike sells direct to the customer. They have their own stores, but a lot of their sales actually come from other retailers. And so it's important to recognize that other retailers are their customers as well. The key thing here, though, is that there's not one customer or even a small group of customers that make up most of or a meaningful portion of Nike's sales. So and there are also additionally the other firms in the industry sales. So the buyer power is also low here, which creates more profitability within that industry. So what is Nike's general corporate strategy? Nike's general corporate strategy is differentiation. And one way you know this is because the Nike brand is kind of iconic. The swoosh, they try to come out with new ideas and new types of shoes. They put a lot of emphasis on athletes and achieving your best and really being a different kind of company, a different and helping you achieve your athletic goals. So generally we call this differentiation. They're not out there trying to compete on price to say, well, we're cheaper than Adidas, we're cheaper than Reebok, but what they're trying to do is show that they're a better shoe or a better apparel brand than those other companies. I mentioned focus before. And like I said before, this can be a little bit more difficult. So when we talk about differentiation focus, we'd actually talk, Nike wouldn't be a good example of this because they don't go after, a specific subset of the marketplace. A good example of this might be Rolex. Okay, so Rolex is a very high cost watch company. Okay, and they don't go after, their target market isn't everybody who wants to wear watches, okay? Or even everyone who can afford their watches isn't really their target market. Their target market is a specific subset of people that would find value in a high cost watch, and that's not everybody. Other brands like Porsche, Ferrari, and companies like that, even though they have a differentiation strategy, They are focused on a specific subset of the population that they're trying to get to buy their company, because they know that subset is more likely to want their products, and they don't want to spend the time and the energy and the money chasing after a portion of the population that just would not be interested in what they have to sell. So that's it for this set of notes. Please let me know if you have any questions.